This is Steve Brennan, Manager Partner at Select Financial Capital. Thanks for joining me today for part one, where I'll be presenting some information on the state of office properties in the commercial real estate market. I hope you'll also join for part two, a roundtable discussion with some of my other managing partners, where we will give our views and our outlooks. In terms of office, currently, many professional investors rank it as the most attractive risk-adjusted area in real estate. Office downtown and office suburban are ranked here at 1 and 3 respectively in terms of the areas with the most attractive risk-adjusted returns through 2023. Part of the reason for this is cap rates. Quite frankly, you can get more for your buck in office than other segments. In this chart, you can see that cap rates for office at the end of Q2 2022 were at 7% versus industrial at 6.3, multifamily at 5.1, and retail at 6.8. Part of this is also due to the fact that office has just had less appreciation than these other sectors. Year over year, ending in the Q2, office was up only 10% versus industrial, for example, that was up over 25%. Now, it's not a secret why office is lagging and why a lot of people are avoiding this sector. COVID had a big impact with people not in the office, people working remotely, vacancy rates going very high, and negative trends in absorption also. Here you can see those trends do seem to be improving, though. The vacancy rate is flattening out after some steep increases. New supply coming in the market, while we still are seeing new supply, the amount of it has been falling. And absorptions actually moved to being positive after being very negative during the lockdowns. As mentioned, new supply is definitely trending down. You can see here that we're coming back to a more average level of new supply as people have pulled back on construction projects for new office. You can also see here that absorption is starting to move in the right direction. We can also see here that downtown rents, multifamily apartment rents, have been moving higher with the anticipation of more activity in downtown businesses, more use of offices. However, we are also seeing record subleases. So there's continued weakness in the sector. We're also seeing that we still got quite a ways to go in terms of return to office. This data really, though, is heavily focused on central business districts, Class A properties. But we can see, especially when you look at some of those business districts, there's still quite a ways to go to getting people back into the office. But we're going to also go into how data does differ a bit by sector, by metro, by type of office, and so forth. Despite concerns that nobody's going to come back to the office or companies are simply planning to continue to work remotely, that's really not the case. Here we can see a survey with recent data from June that is showing that almost 80% of companies are planning to actually move to a hybrid model, where workers are in the office some of the time and out of the office some of the other time. Currently, those expectations, and this is going to be a bit skewed again to kind of Class A to really kind of large companies based on who was being surveyed here. Plans are to have folks in the office about half-time. But we can see reasons why that could actually go up in terms of how much companies want people in the office. We've definitely seen a decline in productivity here. This chart shows descending non-farm business sector productivity. It's also showing a descending number of patents issued. Folks working from home quite simply aren't as productive as they are when you have those teams most of the time in the office. And there's an incentive for employers to try to get more people into the office over time. However, employees right now have some bargaining power. Right now, you can see that the number of job openings has increased, while the number of unemployed has gone down. This does allow workers to have some negotiating power to try to get more time at home. If we see, though, continued weakness in the economy, that could take some of that bargaining power away from those workers. Now, there's a temptation to kind of look at the office sector as all the same, and it really isn't. One thing we've seen is a disproportionate amount of the work from home trend really coming from the tech sector. In this survey, taken back really during the height of the lockdowns, you can see that computer and mathematical type occupations were teleworking 50%, while other occupations were being out of the workplace only 14%. And we see that in other places in data too, that the impact on tech has been much more significant than the impact in other sectors. And it really is almost apples to oranges. The difference can be so marked. Just to give an example, a recent building we purchased as an investment group was medical office outside Savannah, Georgia, which is markedly different than a Class A high-rise in San Francisco catering to tech workers. It really is two entirely different investments, even though they both get categorized in office. And on that point, we can see a lot of divergence across metros. We've seen Texas and Florida doing very well. One of these charts is going to show in terms of metro office employment, a lot of areas from Texas and from Florida really being at the top of the chart. Conversely, we've seen a lot of weakness in some areas. Going back to tech, in San Francisco and San Jose, you can see that those are on the list here for really having subpar performance when it comes to office occupancy, when it comes to office employment. And going back to that theme at the top here, in terms of subleasing space is Chicago. Silicon Valley, San Francisco also makes the list. Areas with the slowest absorption, we see New York, San Francisco, again, we see Chicago. There are some metros and some downtown areas that are definitely struggling, much more so than other areas. Here we can see, again, San Francisco and Chicago are still losing more people than they're gaining in terms of inbound moves of businesses. On the other hand, metros that are doing well, we see some of the areas that we've focused a lot of our attention on in investing. Sunbelt areas, again, Florida, where we've been active in, Savannah, Georgia, where we've been active in, makes the list. But certainly more business-friendly states and areas seem to be having much different fortunes when it comes to office. We're also seeing a trend of a move to the suburbs amidst some continued weakness in a lot of those urban core areas, a lot of the central business districts. Here we can see that absorption is markedly better in the suburbs. And we can also actually see that as folks do return to work, that the vacancy rates for suburbs has really kind of leveled off and is now actually below the vacancy rates you see in central business districts. So to summarize some of the most recent data we've been reviewing and we've been getting as we move through 2022, office does offer superior cap rates. However, we have seen divergences across metros. We've seen more strength in suburbs versus central business districts in different sectors. Central business districts linked to tech probably have the most upside. They also seem to have the most downside, the highest risk-reward ratios. As for us, we tend to not want to embrace those kind of levels of risk. So we're really focusing more as we do our investment surveys and analysis on areas where we think the risk levels are lower. And we are seeing metro divergences. We're continuing to focus on metros that have positive demographics. We're also seeing the Sunbelt and business-friendly areas doing better. And we're also seeing a migration to the suburbs to a certain extent. Would also like to reinforce that despite the popular myth out there that people just aren't coming back to the office, the fact is that even amongst tech companies that have been very much impacted by this, their plans are to move to more of a hybrid model. And of course, there's many offices like medical office where people just simply have to be in the office. Other properties we've done have been very community centered with jobs where folks really just have to be present. And on that note, non-tech has been a lot less impacted. So when we look at office, a sector that is out of favor right now, we certainly understand some of the negative trends. There are certain areas that we quite frankly are leery of, but we think there's also mispricing opportunities. We think there's sectors, segments, metros, areas that are trending quite well and where there's some real opportunity. Office does look like the sector that maybe has the most going on in terms of multiple trends, some positive, some negative. We do believe that is creating mispricing opportunities in some areas and some attractive investments, but definitely an area where you need to do your homework. Thanks for joining me. Again, this is Steve Brennan, Managing Partner at Select Financial Capital. I hope you will also click and join for part 2, a roundtable discussion where I discuss with my other managing partners some of this data and our outlook and our opinions on the future of office. You can visit our website at www.selectfincap.com. Again, that's www.selectfincap.com. Thank you very much.